Hello everyone, and thank you for joining today's True Trading webinar. I'm excited to be here with you. First, a disclaimer. My name is Mohammed Azim from Traders United. House rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified elite wave analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of elite wave theory. In addition to my work as an analyst, I'm also an author and educator. I wrote Introduction to Elite Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elite Wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So, whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the main session goals. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. So I'm going to discuss the consumer price index CPI related to Australia, and the currency I'm going to focus is the AUD USD currency pair. Next one is the gross domestic product GDP related to Canada, and I'm going to focus on USD-CAD currency pair. So let us start with the CPI, Consumer Price Index. QQ means quarterly, related to Australia. So what is the Consumer Price Index? The Consumer Price Index, also known as CPI, measures the quarterly change in prices of a broad basket of goods and services. It is one of the most important indicators of inflation and plays a direct role in shaping the Reserve Bank of Australia's monetary policy decisions. A higher CPI reading typically signals rising inflation, which may prompt the Reserve Bank of Australia to raise interest rates, a move that often strengthens the Australian dollar. Conversely, a lower CPI indicates cooling inflation, increasing the likelihood of future rate cuts and putting downward pressure on the AUD. In short, CPI provides investors and policymakers with a snapshot of consumer purchasing power and helps shape expectations for Australia's economic outlook. Okay, the event details is the Australian Consumer Price Index CPI, and the date was October 29th. Time is 12:30 p.m. 12:30 a.m. UTC time. The previous number was 0.7%. Forecast was 1.1%, and the actual number we got is 1.3%. So we got a good number, 1.3% number, which is good. So up next is the Australia's quarterly consumer price index, which has just been just released, coming in a bit higher at 1.3% from 0.7% previous quarterly number. This confirms that inflation continues to rise at a modest pace, keeping the Reserve Bank of Australia in a data dependent position as it balances between curbing price growth and sustaining economic momentum. The inline result has still given some strength to the Australian dollar, with AUD USD moving higher following the release, as traders interpret the steady inflation pace as supporting the Reserve Bank of Australia's current hawkish bias. The Reserve Bank of Australia has been maintaining a cautious but firm tone, emphasizing that inflation remains above its target range of 2 to 3%. The CPI data at 1.3% confirm inflationary pressures persist, reducing the likelihood of any near-term rate cuts. Forex market viewed this as slightly hawkish, the 1.3 number, not because inflation accelerated, but because it remains solidly above the Reserve Bank of Australia's comfort zone. As a result, AUD/USD strengthened after the release, reflecting expectations that the Reserve Bank of Australia will keep interest rates elevated for longer. Let me show you the chart of AUD/USD currency pair. So here's the chart of AUD/USD currency pair. So right over here, we got the number on October 29th, and price action kind of first it rallied up, then it dropped. Okay, so the market scenario that we got after the news was that the AUD/USD currency pair actually started the decline and is still going down as of today. This was a breakout. I will talk more about it later. So due to the 1.3% number, the CPI number that we got related to Australia, the AUD/USD currency pair actually started the decline. Okay. Next one is the GDP, gross domestic product, related to Canada, and I'm going to discuss the USD/CAD currency pair. Now, what is the gross domestic product? The gross domestic product, or GDP, measures the total value of all goods and services produced in Canada over a specific period. It's the most comprehensive indicator of economic activity and growth. A stronger than expected GDP reading suggests that the Canadian economy is expanding faster than anticipated. This could increase the likelihood of interest rate hikes by the Bank of Canada and typically strengthens the Canadian dollar. Conversely, weaker GDP data signals slower growth and could prompt the Bank of England to adopt a more dovish stance, potentially weighing on the CAD. So the overall GDP plays a crucial role in shaping market sentiment, monetary policy expectations, and the direction of the USD/CAD currency pair. So Canadian dollar gross domestic product that we got is on October 31st, 2025 at 12:30 p.m. UTC time. The previous number was 0.3%, forecast was 0.0%, and the actual number we got is minus 0.3%, which is not a good number. That's why it's written in red color. So market was kind of expecting a neutral number like 0.0% number, but instead of that we got a minus 0.3% number. Now let me show you what happened on a price chart after the data release in USD/CAD currency pair. Now what happened is that on 31st October we got the news out of related to GDP, and the USD/CAD currency pair rallied up, and as of today price action is still going up. We can draw a simple trend channel line over here which shows multiple overlaps, but at the same time it is still an uptrend going on inside USD/CAD currency pair. So the way I see, USD/CAD is probably going to rise up more. Okay, expect some sort of a bullish rally, and then we might get a decline in price action of US dollar versus Canadian dollar currency pair. But for the time being, it looks bullish. So the actual forecast did not match, the actual number did not match the forecast number, and that was kind of a bit of a surprise in the market. And due to this minus 0.3% number, the price action in USD CAD currency pair actually, it moved up. The USD CAD's upward reaction underscores the strength of US fundamentals and global risk aversion, and short term Forex traders should watch for resistance near recent highs, while longer term sentiment may remain bullish on USD CAD unless Bank of Canada guidance turns more hawkish. Okay. Now, let us take a look at previous week global market trends. First one is the euro dollar, next one is the US dollar Swiss franc currency pair. So let us take a look at euro dollar. Euro USD is actually falling down. Okay, this is what I mentioned already, that the way market is behaving, we are probably going to uh, get a drop in price action. Okay, so it is possible that euro is going to stop the decline this week or maybe next week, and then market is probably going to print a bottom, and then further upside in euro dollar currency pair. If you take a look at a daily time frame, I was expecting a drop in price action, and this is exactly what we got over here. Okay, and price action is still going down. Okay, and this means the euro USD is falling down, then expect a bullish rise inside US dollar Swiss franc currency pair. So over here we got this kind of a bullish breakout in a weekly chart. In daily time frame, the price action of US dollar Swiss franc is showing bullish price action over here. So this was a bullish breakout. Then market rallied up. Then we got a retest, a pullback right at this broken trend line, which is now acting as a support level. And we got this doji type candlestick over here, and then market bounced back up from these lows. So I would prefer to look for further upside in US dollar Swiss franc currency pair. Now, market is basically approaching this old swing high, this resistance over here. So we might see some sort of a sideways price action, or maybe a top in coming trading days. So on a short-term basis, the trend is obviously up inside US dollar Swiss franc. And maybe after this bullish rally, or once market completes this bullish rally, then US dollar Swiss franc is probably going to start the decline, and this means euro USD is probably going to print a bottom. But if you take a look at a 4-hour chart, so far price just keep going down and down, so it looks bearish. The euro USD currency pair looks quite bearish. Next, let us talk about the current week macroeconomic events and financial news releases. I will be covering the key developments in Forex market with a focus on fundamental analysis. The first one is the official bank rate related to United Kingdom, and I'm going to focus on GBPUSD currency pair. This news will come out on November 6th. Second one is the unemployment rate related to Canada, and I'm going to discuss USDCAD currency pair. And we will get this financial data news release on November 7th at 1:30 p.m. UTC time. So let's talk about the first news over here, official bank rate, United Kingdom. So what is the official bank rate in United Kingdom? The official bank rate set by the Bank of England (BoE) is the benchmark interest rate that influences borrowing costs throughout the UK economy. It determines how much commercial banks pay to borrow from the central bank and directly affects mortgages, business loans, and savings rates. A rate hike generally strengthens the British pound as higher interest rate attract foreign investment and reflect tighter monetary policy. Conversely, a rate cut tends to weaken the pound, signaling easier policy and slower economic momentum. For forex traders, the bank rate is a key driver of GBPUSD as it shapes expectations around growth, inflation, and the Bank of England's future monetary stance. Okay, let me provide more even details. The official bank rate related to United Kingdom. We will get this data report on November 6, 2025. And the previous number we got was 4%. The forecast is also 4%, and the actual data not yet released. And the pair we're going to focus is the GBP/USD currency pair. So up next, all attention turns to the Bank of England's interest rate decisions scheduled for 12 p.m. UTC time on November 6th. Forex market widely expects the Bank of England to hold the bank rate steady at 4%. So we're basically expecting the interest rate to stay the same at 4%, marking another pause as policymakers balance persistent inflation pressures against slowing economic growth. The British pound has been trading cautiously ahead of the decision, with investors waiting to hear the central bank's latest comments on inflation trends and the outlook for 2026. The UK economy continues to navigate a challenging environment. Inflation remains above target, but growth has shown signs of stagnation. The Bank of England has kept a firm stance against cutting rates prematurely, emphasizing the need to see clear progress towards its 2% inflation target. Uh, an interest rate hold at 4% would align with forex market expectations and signal that the Bank of England remains in a data dependent mode. However, any hawkish tone in the accompanying statements, such as concern about sticky inflation, could lift the British pound. Conversely, dovish guidance highlighting weaker demand or rising unemployment could weigh on GBPUSD as forex markets price in earlier rate cuts in 2026. Now, the potential market reaction and the scenario breakdown is if the Bank of England raises interest rates, meaning we get a 4.25% number, which is greater than 4%, that would be a surprise rate hike. And this would likely trigger a strong rally in the British pound. Let me show you the chart of GBPUSD currency pair. Uh, Probably GBPUSD is actually kind of going down over here. So let's take a look at pound dollar. So this is the chart of GBPUSD currency pairs, the weekly. This one is the daily time frame, and market is currently falling down. So if we get an interest rate at 4.25%, we get a surprise in rate hike, then it would indicate that inflation risks remain uncomfortably high, and GBPUSD is probably going to show us a bullish rally over here. Now, if the Bank of England holds the interest rate at 4%, which is obviously the expected scenario, that's the forecast, then a rate hold would likely result in a measured reaction, a muted reaction. Market is probably going to move sideways. However, if the Bank of England signals caution and keeps the door open to further tightening, the pair could gain modestly. Now, if the Bank of England cuts the interest rate, let's say the 4% becomes 3.75% number, then a rate cut would likely weaken the British pound. Now, it's already going down. The GBPUSD decline is telling us that the United States dollar is becoming strong and British pound is becoming weak. That's the interpretation of this decline. So if we do get a rate cut, that would likely weaken the British pound, as it would signal that the Bank of England focus has shifted towards supporting growth over controlling inflation. Such a move would surprise forex markets and could push the PUSD lower, especially if the US data remaining strong. So the overall analysis and the key takeaway is the decision is less about the headline rate and more about the tone of the Bank of England's communication. With inflation still above the target range but easing gradually, policymakers face a difficult act between maintaining price stability and preventing a steeper slowdown. Forex traders will pay close attention to any forward guidance about when the Bank of England might start cutting interest rate in 2026. A neutral or hawkish statement would support the GBPUSD currency pair, while a dovish shift could send the British pound lower. Okay, so the trading outlook is expect a heightened volatility around the news release. Forex traders should watch not only the rate decision but also the monetary policy summary and vote split, which can hint at internal divisions within the Bank of England. A tighter vote or hawkish commentary could strengthen the GBPUSD currency pair, while cautious or dovish remarks may lead to renewed British pound weakness. So the key takeaway is the Bank of England is expected to keep interest rates steady at 4%, but the tone of its message will dictate the next move for the British pound. The GBPUSD traders, this decision for GBPUSD traders, this decision could set the near-term direction as forex markets weigh whether the Bank of England next step in 2026 will be to hold, hike, or finally begin cutting interest rates. Next one is the unemployment rate related to Canada, and let's talk about it. So, what is the unemployment rate in Canada? The unemployment rate measures the percentage of Canada's labor force that is without work but actually actively seeking employment. It is a key financial indicator of overall economic health and economic strength, household spending potential, and business confidence. A rising unemployment rate typically signals a cooling economy and weaker labor market conditions, which is obviously bad for the Canadian dollar. This can put the downward pressure on the Canadian dollar as it increases the chances of monetary easing by the Bank of Canada. Conversely, a decline in unemployment figures indicates stronger job creation and economic resilience, which generally supports the CAD by reducing expectations for near-term rate cuts. For forex traders, this report is a major driver of USD-CAD as labor market trends heavily influence the Bank of Canada's policy outlook and the relative strength of the Canadian economy compared to the USA. So the previous number we got was 7.1% number. The forecast is also 7.1% number. The actual data is going to be released on November 7th at 1:30 p.m. UTC time. So focus turns on Canada's latest unemployment rate report scheduled for release at 1:30 p.m. UTC time on November 7th. So forex markets are expecting the jobless rate to remain steady at 7.1%, matching last month's figure. This comes as investors closely watch signs of strain in Canada's labor market following months of high borrowing costs and moderate economic growth. The data will provide key insight into whether the Bank of Canada can maintain its current policy stance or if growing labor market weakness could prompt a more dovish shift. The Canadian labor market has gradually softened in recent months, by the way, as tighter financial conditions slow hiring and weigh on consumer demand. While job creation continues, it has not kept pace with population growth, causing the unemployment rate to drift higher from earlier lows. The Bank of Canada remains cautious, and acknowledging the need to balance inflation control with the risk of rising joblessness. The unemployment rate remains at 7.1% as expected. It would suggest that the labor market is stabilizing but still under mild pressure. However, a lower reading would indicate renewed strength and could lift the CAD, while a higher figure would confirm further cooling in employment conditions and weigh on the currency. Let's talk about potential market reactions and different scenarios. If unemployment rate is lower than expected, meaning let's say you get a 6.9% number instead of 7.1%, then it means a stronger labor report would likely boost the Canadian dollar as it shows ongoing resilience in the job market. Forex traders may translate this as reducing the odds of near-term rate cuts, pushing the USD CAD lower. Now, at this point in time, if you take a look at the price chart of USD CAD currency pair, USD CAD is actually going up. So, in other words, the United States dollar is becoming strong and Canadian dollar is becoming weak. Okay. Now, let's say we get a 7.1% number. So, it means the unemployment rate matches the forecasted number. Then, an inline result would likely trigger a sideways market response, and it would confirm a steady but slightly soft labor market, keeping the Bank of Canada in wait and see mode. So USD CAD may, go in a some kind of a trading range or just go sideways. Now, if the unemployment rate is higher than expected, let's say we get a 7.3% number or any number greater than 7.1%, then a higher reading would be bearish for the CAD and signaling, a deeper labor market weakness and raising speculation of Bank of Canada's policy easing in the early year 2026. In that scenario, forex traders may buy USD CAD as rate differentials increasingly favor the US dollar. And this is what exactly going on. As of today, USD CAD is going up. And if you check out the last few trading days price action, the USD CAD is overall going up over here. Okay, so the upcoming unemployment rate in Canada will serve as an important financial news, and I would say it's an important barometer for Canada's economic direction. After several months of subdued growth, the Bank of Canada is watching employment data closely for signs that restrictive policy is cooling the economy more than intended. If the jobless rate rises further, it could reinforce expectations for a dovish policy adjustment next year. On the other hand, any surprise improvement could strengthen confidence in the Bank of Canada's ability to maintain its current rate stance. So, the key takeaway is the Canada's unemployment rate remains a critical gauge of economic health and a major influence on the Bank of Canada's policy direction. Even a small surprise in either direction, maybe to the upside or to the downside, could shift short term sentiment for USD CAD, making this financial release one of the most closely watched events for Canadian dollar traders. Next, let us take a look at current week global market trends. I'm going to discuss the euro dollar and Australian dollar currency pair. Regarding the euro USD currency pair, price action is trying to drop over here. And if you take a look at the daily chart, market is kind of, just keep going down over here. This is the support over here at 1.1387. So as soon as price action drop a little bit more, somewhere around this area, okay, then we might get some kind of a buyer support over here, and then um, this support would provide us a possible chance to look for potential buy trade setup over here. Okay, next one is the Australian dollar. Okay, let's go to the AUD USD currency pair. AUD USD currency pair, the overall trend is down. By the way, this is the weekly chart. of Aussie dollar currency pair. And if you take a look at a daily time frame, this looks like to me we got a bullish breakout over here along with a gap in market. Price opened with a gap. Now it's trying to drop back down over here. And let me try to show you the gap over here. Once this was the gap right over here, okay, which market is trying to fill. And today we got this big washout to the downside in AUDUSD currency pair. Next one is the US dollar versus Canadian dollar. USD-CAD currency pair, it looks bullish, and the way I see market is probably going to rise up more. We have some resistance over here, and hopefully price action is not going to test 1.40 level, and it's quite possible that market is probably going to, kind of print a double top pattern over here and then starts the decline over here. Next one is the spot gold. Spot gold, it seems to me we got kind of a long-term top over here. It looks a little bit bearish, but somewhat sideways as well. Overall, it's an uptrend, and the way I see market is probably going to drop a little bit more over here. So this is where we got the daily time frame bullish trend line and then a break to the downside. So we might get a retest of this trend line, and then the price action of gold is probably going to drop even further. So the spot gold looks kind of bearish. Okay, I would say the upcoming direction is bearish. It's a downtrend inside spot gold, like say USD pair. Okay, if you have any questions or comments, feel free to type inside the chat box and I will be happy to answer your questions. So what we have learned today, we discussed about the official bank rate related to United Kingdom, and then we discussed about the unemployment rate related to Canada, USD-CAD, and we discussed about the Euro USD, AUD USD, USD CAD, and spot gold. These are the assets to watch out for profits. What you should do next, stay tuned for the schedule of next week's trading webinar. Subscribe to our social media pages to stay updated with true exciting events, trading content, and market insights. If you want to learn more about trading, visit TradeGeek and access free trading courses for beginner, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, November 11th, 2025 at 12 p.m. UTC, same time. So that's it for the time being from my side. Have a nice day and bye-bye.